It starts with something completely natural. You sit down at your kitchen table, pull out your checkbook, and write a check to your adult son or daughter. Maybe it is $50,000 to help them buy their first home, or maybe it is a few $1,000s to help them get through a difficult financial season. To you, this is not a complex financial transaction. It is simply a parent loving and supporting their child. But the moment that money leaves your hand, a hidden clock starts ticking within a system you might not even realize is watching. A system run by the IRS, state Medicaid agencies, and bank underwriting departments. The danger here is not that you are doing something wrong out of malice. The danger is that the system follows the paperwork, not your family's good intentions. If you are a parent over 60, helping your children financially is one of the most fulfilling things you can do, but doing it the wrong way can quietly trigger a chain reaction that threatens your own retirement security, your home, and the very inheritance you are trying to protect. This video is not about panic. It is about control, clarity, and prevention. Over the next few minutes, we are going to look at exactly how the system views these financial moves, the hidden rules that catch families by surprise, and the simple, responsible steps you can take today to ensure your generosity never turns into a financial trap for you or your children. This information is vital for retired homeowners, Social Security recipients, widows, widowers, and any parent over 60 who has managed to save some money or build equity in a home. It also deeply matters for adult children who are currently helping their aging parents navigate their finances. If you are a renter, or if you have no savings to pass down, some of these specific tax and asset rules might not apply to your situation, but the core principles of protecting your financial independence still hold. You see, many of the traditional financial rules we grew up believing have shifted. What worked for our grandparents' generation can now create severe complications because institutions have become highly automated and strictly regulated. The mistake is quiet because nothing looks wrong when you make it. You do not get an immediate warning from the bank, and your child is genuinely grateful for the help. Everything seems perfectly fine for months or even years. But the system operates on a timeline that often catches up with families long after the money has been spent. Before we look at the specific ways this chain reaction unfolds, you need to understand why the usual advice can backfire. Many well-meaning people will tell you that the easiest way to give your kids their inheritance is to simply give it to them while you are still alive, or to put their names on your accounts to make things simpler. While the emotional logic behind that makes complete sense, the institutional logic is completely different. Let's break down exactly what happens behind the scenes when a seemingly harmless financial decision triggers a chain of events that can compromise your financial freedom. Main body. Chain number 1, the joint account shortcut. Let's look at the first common chain of consequences, which often begins with a desire for simplicity. Imagine a retired mother, perhaps a widow, who wants to ensure that if anything ever happens to her, her daughter can access her checking and savings accounts to pay her bills. To make things easy, she visits her local bank branch and adds her daughter as a joint owner on the accounts. On paper, this feels like an elegant solution. The daughter is responsible, she loves her mother, and now she can sign checks or make withdrawals if an emergency arises. But the moment that signature card is filed, the first link in a dangerous chain is forged. By adding her daughter as a joint owner, the mother has not just given her permission to use the account. In the eyes of the banking system and the law, she has legally gifted a portion of that asset. The money in that account no longer belongs solely to the mother. It belongs equally to the daughter. The second consequence of this quiet decision usually arrives completely out of nowhere, unrelated to anything the mother or daughter did together. Let's say the daughter gets into a car accident, or faces an unexpected medical crisis of her own, or her small business goes through a severe downturn. If a creditor obtains a legal judgment against the daughter, or if she faces a difficult divorce, that joint bank account is now viewed as an available asset by outside parties. A collection agency or a court order can legally freeze or seize the funds in that account to satisfy the daughter's debts. The bank does not look at the history of the account to see that every single dollar came from the mother's hard-earned pension or Social Security. The system simply looks at the names on the title. The third link in this chain is the one families usually discover too late, and it involves the rules surrounding long-term care. If the mother later experiences a health decline and needs to apply for Medicaid to help cover the astronomical costs of assisted living or nursing home care, the state will closely examine her financial records. They look back through a specific window of time, which in most states is 5 years. When the caseworkers see that a child's name was added to a bank account, or that large sums were moved out of the mother's sole control, they may classify that transaction as a disqualifying transfer of assets. The system does not care that the daughter never spent a dime of the money for herself. The transfer of ownership itself is what triggers the penalty. This can lead to a devastating scenario where the mother is denied benefits for a specific number of months, leaving the family scrambling to pay for care out of pocket. All of this happens because of a simple 5-minute meeting at a bank counter that was intended to make life easier. Chain number 2, the undocumented real estate gift. The second chain of consequences involves helping a child secure a piece of property. Suppose a father wants to help his son buy a house. The son has a good job, but interest rates are high, and saving for a down payment is incredibly difficult in today's market. The father decides to write a check for $60,000 directly to the son to cover the down payment, or perhaps he signs his name as a co-signer on the mortgage to help the son qualify for a better rate. Again, this action is rooted in deep parental love and a desire to see the next generation succeed. The first consequence is often a quiet compliance issue with the IRS. While most people know that you can give a certain amount of money to an individual each year without paying a gift tax, many seniors do not realize that if you exceed that annual threshold, you are legally required to file a specific tax form called an informational gift tax return. You might not owe an actual tax immediately because of the large lifetime gift exemptions allowed by federal law, but failing to file the proper paperwork can flag your accounts for future audit or complicate your estate planning down the road. The second link in this chain reveals itself if the child's personal life takes an unexpected turn. If the son gets married and those gifted funds are deposited into a joint account with his new spouse to purchase the home, that money can quickly lose its status as a separate inheritance. If that marriage unfortunately ends in a divorce a few years later, the family court may view the equity in that home, including the father's initial $60,000, as marital property to be split down the middle. The father's hard-earned retirement savings can accidentally end up in the hands of an ex-spouse, entirely because the gift was made directly and without any legal structure to protect it as a separate family asset. Before we move to the next link, look at this from the adult child's perspective. The child does not want to put their parents' financial stability at risk, but because they do not understand the underlying rules of the mortgage or the tax code, they accept the help gracefully, assuming that because the bank approved the transaction, everything must be perfectly legal and safe. But the third consequence appears if the parent ever needs financial flexibility later in their own retirement. If you co-sign a mortgage for your child, that entire debt obligation appears on your personal credit report. If you later need to downsize your own home, take out a home equity line of credit to repair your roof, or refinance your own property to cover unexpected medical bills, you may find yourself rejected by lenders. The banking system looks at your debt-to-income ratio and sees that you are legally responsible for your child's entire housing debt, making you look far too risky on paper, despite your lifetime of excellent financial behavior. Chain number 3, the carryover basis tax trap. The third chain of consequences is perhaps the most financially damaging, and it involves gifting real estate directly to children while you are still alive. This often happens when a senior homeowner hears a rumor at a senior center or reads a confusing article online about the horrors of the probate court. To avoid probate, the parent decides to sign a quitclaim deed, transferring the title of their paid-off family home directly into their children's names, while continuing to live in the house. The first consequence of this action hits almost immediately in the form of lost protections. In many states and municipalities, senior citizens enjoy substantial property tax exemptions, homestead protections, and utility discounts based on their age and income. The moment the title shifts to an adult child who does not meet those age or income requirements, those exemptions can vanish. The annual property tax bill can skyrocket overnight, creating an immediate and unexpected financial strain on the household budget. The second consequence is far more serious and involves the tax concept known as cost basis. The mistake is quiet because nothing looks wrong when you sign the deed at the county clerk's office. But look at what happens when your child eventually decides to sell that property years down the road. If you gift your house to your children while you are alive, they inherit your original cost basis, the amount you paid for the house decades ago, plus any capital improvements. If you bought the house in the 1,980 seconds for $50,000 and it is now worth $400,000, your children's tax basis is $50,000. When they sell it, they could face a massive federal and state capital gains tax bill on that $350,000 difference. Conversely, if they were to inherit that same property after you're passing through a properly structured estate plan, such as a living trust or a transfer on death deed, they would receive what the IRS calls a stepped-up basis. Their tax basis would automatically reset to the fair market value of the home on the date of your death. If the home is worth $400,000 when you pass away and they sell it for $400,000, their taxable gain is exactly zero. By trying to save a few $100s in probate fees, the quiet mistake chain can accidentally cost your children tens of thousands of dollars in unnecessary taxes. The final link in this specific chain involves the terrifying vulnerability of your living situation. If your child becomes the legal owner of your home, and that child experiences a sudden bankruptcy, a severe tax lien from the IRS, or a devastating lawsuit, their creditors can legally attach a claim to your house. You could find yourself in a position where the roof over your head is caught in a legal battle that has absolutely nothing to do with you, and you have no legal standing to stop it because you gave up your ownership rights years prior. Now that we have looked at how these quiet mistake chains unfold, let us focus entirely on control, clarity, and prevention. This does not mean you should stop helping your family. It means you must change the mechanism of how you give that help. There are highly effective, legal, and responsible ways to support your children without exposing yourself or your assets to unnecessary risks. First, if you want your children to be able to assist you with your finances or pay your bills in an emergency, do not add them as joint owners to your bank accounts. Instead, consult a qualified professional in your state to establish a durable financial power of attorney. This legal document grants your chosen child the authority to manage your accounts on your behalf, but it does not grant them ownership. The money stays yours entirely, meaning it remains completely protected from their creditors, their lawsuits, or their potential divorces. Furthermore, you can speak with your bank about adding a payable on death or transfer on death designation to your accounts. This ensures that the moment you pass away, the funds transfer directly to your children without going through probate, while keeping the asset entirely within your secure control during your lifetime. Second, if you are planning to give a substantial cash gift to help a child purchase a home or start a business, do not simply write a casual check. Instead, consider structuring the transaction as a formal intra-family loan with a properly drafted promissory note. You can set a very reasonable interest rate that complies with the IRS applicable federal rates. This protects the money in several ways. If your child ever goes through a divorce, that money is documented as a structural family debt that must be repaid to you, rather than a marital asset to be split with a future ex-spouse. If you later need that money back due to an unexpected medical emergency, you have a legal framework to request repayment. If you decide later on to forgive the loan payments annually within the legal gift limits, you can do so responsibly while keeping a clean paper trail for tax and Medicaid purposes. Third, if your primary goal is to protect your home from probate or ensure it transfers smoothly to your children without tax penalties, look into a revocable living trust or a transfer on death deed, depending on what is legally recognized in your specific state. A living trust keeps the property entirely under your control while you are alive, preserves your senior property tax exemptions, and ensures your children receive the vital stepped-up tax basis upon your passing, saving them from a capital gains nightmare. It provides a complete shield against probate without requiring you to sign away your independence or your security while you are still using the home. A quick reminder, rules, tax thresholds, and Medicaid lookback exceptions vary significantly from state to state. This information is designed to be an educational warning system, so you know exactly what questions to ask. Before you alter any deeds, move significant funds, or sign financial agreements, you should always review your plans with a qualified estate planning attorney, a certified public accountant, or a licensed financial professional who understands the specific regulations of your home state. To summarize everything we have discussed today, the most important lesson is that the system does not always know your family's unique story or your loving intentions. The institutions, courts, and tax agencies look strictly at the records in front of them. Gifting money or assets to your children through shortcuts, like adding them to titles, creating joint bank accounts, or making unrecorded cash transfers, can set off an invisible chain of events that exposes your hard-earned savings to outside liabilities, unexpected tax burdens, and severe benefit penalties. True family protection is not just about giving generously. It is about giving wisely. By taking the time to set up formal legal structures, ensuring your paperwork matches your true intent, and keeping your assets clearly in your own name during your retirement years, you are protecting both yourself and the people you love. A simple, careful review of your accounts and documents today can save your family months of confusion, legal stress, and unnecessary financial loss in the future. If you found this explanation helpful, please share this video with the person in your family who helps keep track of the paperwork, or with a friend who might be considering helping their kids with a down payment or an account transition. I would love to hear from you in the comments section below. Let me know which of these areas you would like us to cover in greater detail in our next video. Are you currently trying to figure out the rules for property deeds, beneficiary forms, power of attorney documents, or Social Security survivor benefits? Your feedback helps us create the practical, protective guides you need most. Thank you for watching. Take control of your paperwork today, and we will see you in the next video.